Welcome to Realty Reels, your go-to Aussie channel for property insights and market trends. Don't forget to like, share, and subscribe to get closer to your real estate dream.
How smart investors keep buying property, even with high interest rates. Have you ever wondered how some property investors own 5, 6, even 10 properties, while you're struggling to get approved for just one? Interest rates are higher, banks are stricter, and yet somehow, other investors keep moving forward. So what do they know that you don't? Today I'm breaking down 5 essential ways property investors can seriously improve their borrowing capacity. And no, this is not the usual just earn more income advice. Hi everyone, welcome back to Realty Reels. Now, borrowing money in Australia has become tougher than it was 2 or 3 years ago. Rates aren't historically high, but serviceability rules have changed the game. If you're trying to start or grow a portfolio and thinking, how on earth are other people doing this? This episode is for you. These are practical, strategic ideas used by experienced investors and mortgage professionals every day. Your structure matters more than you think. Let's start with the big one: entity structure. Most everyday investors buy property in their own name or jointly with their partner. The problem? Every single loan eats into your personal borrowing capacity. Once it's on your credit report, the bank can't ignore it. This is where trusts come into play. When structured correctly, a trust is treated as a separate legal entity, not you personally. That means future borrowing can often be assessed without stacking all previous investment debt against your name. And here's the counterintuitive bit: trusts aren't just for the wealthy. In fact, mid-income households, roughly earning between $250,000 and $400,000 combined, benefit the most. Why? Because they hit borrowing limits much faster. Trusts preserve borrowing capacity. When you borrow through a trust, you're usually a guarantor, not the main borrower. Banks then ask one key question: is this trust self-sufficient? If the trust can service its own debt or be supported in a structured, documented way, many lenders will limit how much that debt impacts your personal borrowing power. That's how investors keep going when others hit a wall after 2 or 3 properties. And no, you don't always need one property per trust. Some lenders allow multiple properties within the same trust, depending on income and policy, which can significantly reduce setup and admin costs. What if the properties aren't cash flow positive? Let's be honest, in Sydney, Melbourne, or Brisbane, it's tough to find properties that fully pay for themselves at today's rates. So what happens if your trust runs at a small loss? Here's the key insight: self-sufficient doesn't always mean cash flow positive. If guarantors that you legally contribute funds to cover a shortfall, accountants can often certify that the trust can still meet its obligations. From a lender's perspective, if the trust has enough funds to service its liabilities, it may still be treated as sustainable. That's a massive difference compared to holding everything personally, where every dollar of loss hits your serviceability immediately. Lender policy shopping is a superpower. Not all banks view trusts, expenses, or existing loans the same way. Some lenders are conservative, others are far more flexible. Experienced brokers don't just look at interest rates, they look at policy nuance. Things like how household expenses are calculated, how rental shading works, and whether existing trust debt can be excluded. Choosing the right lender can mean the difference between buying one more property or 3. Loan structure matters, not just loan size. Finally, let's talk about interest-only versus principal and interest. In the early stages of investing, interest-only loans can significantly improve cash flow and serviceability. Lower repayments mean less strain on your borrowing power, especially when combined with the right structure. It's not about avoiding principal forever, it's about using the right tool at the right stage of your journey. So here's the big takeaway. Most investors don't fail because they earn too little. They fail because they structure poorly from the start. The right entity, the right lender, and the right loan strategy can dramatically extend your investing lifespan. If you found this helpful, don't forget to like the video, Subscribe to Realty Reels and stay tuned for more real-world property insights that actually move the needle. See you in the next one.